Okay? Now, in our final story tonight, we need to talk about something that should have every single person paying attention right now. And that's the state of the economy in the US. And look, I want to be crystal clear from jump. We're not sitting here making predictions about crashes or telling you the sky is definitely falling tomorrow. But what we are going to show you today are warning signs. Multiple warning signs, all flashing at the same time. And that's something we haven't seen since other major economic disruptions. Let's start with what the so-called smart money is telling us. A survey done by Bank of America shows us something we've never seen before. A record 91% of fund managers believes U.S. equities are overvalued. Now look at this chart. The dark blue line is climbing to levels we haven't seen since they started doing this survey back in 2001. But here's what makes this even more telling. At the same time, 49% of these same managers think emerging market stocks are undervalued. So it's not that they think all stocks everywhere are expensive. They specifically think American markets have gone completely off the rails, while there are actual bargains elsewhere in the world. When the professionals who manage pension funds and retirement accounts are this unified in their concern, that should begin to worry people. And a massive chunk of those overvalued markets are betting everything on AI. These tech companies have told investors that AI is going to revolutionize everything, justify every sky-high valuation, and generate returns that make today's prices look reasonable. But what happens if AI doesn't deliver what these tech bros promised? What if the productivity gains don't materialize, or the timeline gets pushed back, or the costs end up being higher than the benefits? You're looking at one of the biggest bubble setups in market history, all concentrated in a handful of companies that everyone thinks can't fail. Now here's where it gets dangerous. Not only do fund managers think stocks are overvalued, but they're all positioned the exact same way. 45% of them have their biggest bet on the Magnificent Seven tech stocks. The Magnificent Seven are the 7 largest tech giants in US technology: Apple, Microsoft, Google, Amazon, Nvidia, Tesla, and Meta. Nearly half of professional investors are making essentially the same trade. You know what happens when everyone's on the same side of the boat? Eventually, someone tries to get off. And when 45% of fund managers are all along the same 7 companies and they all think the market's overvalued, what do you think happens when sentiment shifts? This is textbook concentration risk. The kind of setup that turns small problems into big problems really fast. And speaking of big problems, let's talk about housing. This Case-Shiller ratio shows real home prices. That's home prices adjusted for general inflation. And we're right back where we were at the peak of the mid-2000s housing bubble, maybe even higher. Think about that for a second. Home prices, relative to everything else, are as expensive now as they were right before the 2008 financial crisis. That's not sustainable. That's not market dynamics. That's bubble territory. And here's how that bubble is affecting real families. This Google Trends data shows searches for help with mortgages. See those 3 spikes? 2008 financial crisis, COVID pandemic, and right now. Current mortgage stress levels are approaching what we saw during those other major economic disruptions. People are struggling. Families are looking for help with their mortgages at rates we haven't seen since the worst economic crisis in decades. This isn't abstract market data. This is real-world pain showing up in search engines. Now, remember what we talked about last week. U.S. agricultural bankruptcies are on the rise due to Trump's immigration and tariff policies. Well, guess what? That agricultural crisis isn't happening in isolation. It's happening at the exact same time we're seeing these broader economic warning signs. Now, here's another cost hitting families that most people don't even realize is connected to all of this. Residential electricity prices are projected to jump 13% in 2025 and 18% in 2026. And while natural gas prices are also on the rise, gasoline and oil prices are dropping. So why then is electricity, the one energy source you literally can't live without, the one that's skyrocketing? Data centers. The AI boom that's making tech billionaires even richer is forcing regular families to pay for the massive infrastructure needed to power it. We're talking about facilities that use as much electricity as entire cities. And guess who's footing the bill for the new power plants? You know who. Not the tech companies in Louisiana. Now in Louisiana, Meta negotiated a deal where they only pay for about half of the $3 to $4 billion in infrastructure costs for their data center. Everyone else in Louisiana gets stuck with the rest. In Virginia, residential customers will pay about half the cost for new power plants built specifically for data centers, even though household electricity demand has been flat. This is exactly the same pattern we keep seeing. Profits get privatized while costs get socialized. Tech companies make billions from AI, but for working families, they see their electricity bill double to pay for the infrastructure that those companies need. And you can't see that instability playing out in the economic data. Look at this GDP breakdown by component, investment, and contributions, swing from negative 1% to positive 4% quarter to quarter. Import and export numbers, all over the place. This isn't stable growth. This is volatility that suggests the underlying economy is already under stress. So while stocks are overvalued and risky assets are crowded, look where the smart money is actually parking their cash. Short-term U.S. Treasury bonds. When professional investors are this nervous about everything else, they pile into the safest, most liquid investments they can find. This flight to safety in bonds while everything else looks overpriced, that's not a sign of confidence in the economy. That's a sign that people with serious money are battening down the hatches and preparing for turbulence. And here's where Trump's policies come into the picture, and why these warning signs should have everyone concerned. The farming bankruptcies we covered last week, those don't just hurt rural communities. When a third of farmers go under, that creates a cascading crisis. Farm bankruptcies hit rural banks that made agricultural loans. Food prices get more volatile as supply chains break down, rural real estate markets collapse when farms get foreclosed on, and here's what nobody's talking about. A lot of commercial real estate in small towns depend on agricultural income. When the farms fail, Main Street businesses fail, and then you've got empty storefronts and worthless commercial properties. Trump's tariff policies are making those GDP investment and trade swings even more extreme. Businesses can't plan when trade policy changes every few months based on whether Trump tweets that morning. That uncertainty shows up in the investment numbers we're seeing. And here's the kicker. Trump's immigration policies are hitting construction labor just as housing affordability is already at crisis levels. Deporting construction workers while material costs go up from tariffs? That's a recipe for making an already overpriced housing market even more unaffordable. Meanwhile, his tax cuts and deregulation promises are throwing more fuel on asset bubbles that fund managers already think are dangerously overvalued. Now, I want to talk about something that might sound crazy, but deserves serious attention: the probability of a currency reset. Throughout history, when countries face unsustainable debt levels and economic instability, they've sometimes been forced to completely restructure their monetary systems. And oh boy, do we have a debt problem. This chart shows the total debt. We're up to a record $37 trillion. As a percentage of GDP, it's on a trajectory to become higher than World War II. In 1933, FDR took the country off the gold standard and devalued the dollar by 40%. In 1971, Nixon ended the Bretton Woods system and completely severed the dollar's link to gold. Europe has gone through multiple currency resets, from the hyperinflation of the Weimar Republic to the creation of the euro itself. And here's where things get weird. Remember Trump's golden Bitcoin statue? Yeah, that wasn't just a publicity stunt. There are serious people in Trump's orbit talking about backing the dollar with Bitcoin or returning to some form of gold standard, like his son, Eric Trump, and Judy Shelton, one of his long-term advisors and a nominee for the Federal Reserve. When you've got this level of economic instability, bubble markets, massive debt, international tensions over trade, currency resets start looking less like conspiracy theory and more like economic policy. Whether it's Bitcoin, gold, or some new digital currency system, the point is this: when traditional monetary policy stops working, governments start looking at alternative, radical solutions. And all of these warning signs we're seeing, they're exactly the kind of conditions that have historically led to a currency crisis. And whenever a currency resets, it's typically the case that middle and working classes get screwed on the exchange. Think about it. When currencies collapse or get restructured, who has the inside information? Who gets to convert their assets first? Who understands the new system and can position themselves to benefit? It's not a family in New Jersey paying higher electricity bills or the farmers in Arkansas facing bankruptcy. It's the billionaires and their advisors, who often help design these resets in the first place. The wealthy hold assets that hold value through currency transitions, real estate, commodities, and foreign investments. Working families hold dollars in bank accounts, retirement funds, in domestic markets, and wages that get paid in whatever the new currency system decides they're worth. When the rules change, regular people find out after the game is already over. Now look, I'm not sitting here telling you to panic or making predictions about when something's going to break, but I am telling you to pay attention to what's happening. We've got Wall Street professionals saying markets are overvalued at record levels. We've got housing prices back in bubble territory with families desperately searching for mortgage help. We've got farmers facing bankruptcy at unprecedented rates. We've got an economy showing volatility in its core components. And we've got policy decisions that seem designed to make every single one of these problems worse. From farms to Wall Street to Main Street, warning lights are flashing across the entire economic ecosystem. These aren't isolated problems. They're interconnected risks that could amplify each other. The people making policy decisions right now need to understand that when this many warning signs appear simultaneously, the time to act is before something breaks, not after. Because by the time multiple sectors are in crisis at once, your options become a lot more limited and a lot more painful. So again, I just want to make sure you all are aware. I'm not telling you to worry. I'm not telling you to freak out. Don't wig out, man. You know what I'm saying? But we need to think ahead. If you have savings, make sure you're keeping them separate. Make sure you're just doing what you can to help.